So, a warm welcome to everyone to our webinar today on inclusive insurance for climate resilience. If you would like to listen to this webinar in French and Spanish, you will see an interpretation icon at the bottom of your screen. If there is a delay with the French interpretation, please come back and try again in a little bit. But interpretation should be available in both other languages. So firstly, just a big thank you to our donor, the Generation Foundation, for making these webinars possible. And also a big shout out to the Microinsurance Network that has been co-hosting these webinars with us. So this webinar is the sixth webinar in our series called Learning from the Leaders. It is actually also the 6 out of 6, so it's the last one. But just to say that you can find all past recordings from the webinar on our website, and when I have a moment, I will put that in the chat. So these webinar recordings can also be listened to in English, French, and Spanish. So just one housekeeping point about the questions. If you can add your questions to the Q&A section rather than putting them in the chat, that would be really great. And please do add these as we go, as you think of your questions.
Ajoutez vos questions.
Mariam, hello. Okay. All right, so let's keep going. So also, if you can, this is not actually in relation to Mariam, but if you can keep yourself on mute as we present, that would also be great. So just a bit of background to this session. As I'm sure you know, climate change is one of the biggest challenges of the century, and it affects everyone, but especially socially vulnerable groups. And for the ILO in particular, the impact on workers and employers is particularly critical. So climate shocks such as floods, droughts, and heat waves destroy livelihoods and jobs. And we know that 40% of the global labor force depends on agriculture, and 60% works in the informal economy. And most of these people are climate vulnerable. And these disasters are also becoming more frequent and more severe. We know that natural catastrophes have increased 5-fold in the last 50 years. So without action, the costs will be enormous. We'll see rising poverty, widening inequality, climate-induced migration, and growing food insecurity. So solutions that can strengthen financial resilience are urgently needed. So today, we have 3 fantastic speakers who are going to talk about how inclusive insurance can be one of the tools to build financial resilience. And I'm going to start out by introducing our first speaker, and also put his slides up. So our first speaker is Pedro Pinheiro. Pedro, we're really happy to have you on this webinar today. And let me introduce you. So Pedro is Knowledge and Strategic Partnerships Manager at the Microinsurance Network, where he leads engagement with the Insurance Development Forum, the Global Shield Against Climate Risks, and related initiatives. More recently, he has also taken on program leadership of the landscape of
Plus
microinsurance.
récemment, il a pris en charge. Ah non, c'était.
Mariam, yeah. He is a lawyer by training and brings over 15 years of experience in insurance with a strong focus on inclusive insurance, consumer protection, and climate resilience. So Pedro, I'm going to ask you 2 questions, and then I shall hand it over to you. So firstly, what role do you think inclusive insurance plays within broader climate and disaster risk management planning? And how does it contribute to systematic resilience? Essentially, why is inclusive insurance important in this context? And then second question, can we measure the impact of inclusive insurance to build resilience? So Pedro, over to you.
Thank you very much, Lisa. It's an honor and a privilege to be here with you all today. Greetings to my fellow panelists and to everyone who's joining us online. I will attempt to answer your 2 questions while I talk about the role of inclusive insurance in strengthening resilience in an era of compounding risk. If we may go to the first slide, please, Lisa. You have drawn a very good, an excellent backdrop to our discussions in relation to the impacts of climate change across the globe, and particularly to vulnerable populations. So I would start, and I think we share a common understanding of the background. So I would like to start by inviting everyone to reflect on the conventional framework we use to think about risk exposure and insurance penetration, which is typically anchored in premium volume, right? And what I would like to propose today is that we shift the perspective from that common proxy of premium income to deliberately look at the household level and ultimately at the level of individuals and think about the people protection gap. And viewed through these lens, it becomes clear that households do not experience risks in neatly separated categories. What we see is that they face risks that increasingly interact with one another, sometimes with devastating effects. Climate shocks, health events, and livelihood disruptions often occur together or in close succession, reinforcing each other and compounding vulnerability. When the insurance industry, however, looks at a farmer, for example, it tends to see a crop risk, while in reality, that same farmer and their family navigate a much wider set of interconnected exposures, including illness, income volatility, and old age insecurity, much like any other household. In this context, resilience relies heavily on systems capable of delivering rapid liquidity directly to people when a financial shock occurs, before they are forced into distress coping. Inclusive insurance, in particular, can play a key role here by providing prearranged, predictable financing to cope with the risks. It effectively operates as part of the resilience infrastructure for households, enabling them to stabilize consumption, protect productive assets, and recover more quickly, thereby preserving longer-term development gains and reducing the risk of falling into poverty. So more broadly, protection gaps should signal not only limited financial coverage by the insurance industry, as we commonly refer to it, but also deeper weaknesses in human resilience, since delays in accessing funds often carry lasting social and economic consequences. Now, to the next slide, please. I believe it is never too much to highlight that climate vulnerability is a common human challenge, as Lisa said at the beginning. It is not confined to one region or income group, and even developed countries, who, by the way, are historically most responsible for carbon emissions that are causing climate change, are also struggling. In fact, last week I came across this public consultation that's being conducted by the European Union, and I found it quite telling because it explicitly refers to policy challenges, acknowledging that progress in strengthening climate resilience in the European Union is slow and uneven and not keeping pace with accelerating climate change. The language is really strong. It also states that the EU and national resilience policies and measures are currently not fit for purpose and calls for improving access to affordable insurance, see how interesting that is, and reducing the widening insurance protection gap. So at the same time, we know that developing economies and small island states are facing a disproportionate impact of climate change without the same fiscal space, institutional capacity, or risk management tools to cope with it. So while climate vulnerability is shared, the capacity to respond remains deeply unequal. And if we go on to the next slide, just because I didn't want it to be only me saying that, I brought this quote from Dr. Kevin Greenidge, governor of the Central Bank of Barbados, which I also thought was brilliant because it makes the point very clearly from a sovereign perspective. What he affirmed is that small states suffer materially higher disaster losses than larger economies. He was citing the example of Jamaica specifically as a good example of the stacking of risk financing strategies from the macro to the micro level. And he says that on average, annual disaster costs for small states are close to 2% of GDP, several times the burden faced by larger countries. His argument is that a climate resilience system requires a standing stack of instruments that convert disasters into manageable budget events. So he's really looking at it from a fiscal lens and from the perspective of a minister of finance, right? We need to think, according to him, in terms of balance sheets, cash flows, and triggers, not projects with beautiful pictures. And in a way, we can translate that view or filter it down to the level of the household and of individuals that also have their own balance sheets. And inclusive insurance should sit at the end of that standing stack that Dr. Kevin has mentioned. It is the last mile delivery channel that connects risk transfer markets and prearranged disaster risk financing to households and to individuals. Next slide, please. Now, turning into the data and what the landscape of microinsurance tell us in relation to how inclusive insurance is effectively serving currently as a tool to enhance climate resilience, we can see that the sector, inclusive insurance, has expanded considerably over the past decade, but there's still a lot of space for growth. Around 344 million people are currently covered by inclusive insurance across multiple regions in the countries that are mapped by the landscape of microinsurance. But at the same time, the potential target population reaches into the billions, which highlights the magnitude of the remaining protection gaps. The premium volumes, if we want to look at it from that perspective, also remain relatively modest at around 15% compared to the estimated market potential. What we, the Microinsurance Network, believe is that it's important, and if you go deeper into the report, you will see that we are actively trying to address that, to assess inclusive insurance uptake using indicators that reflect its development function and its contribution to resilience outcomes. Next slide, please. Now, if you work in the area of inclusive insurance, you might say, and I'm borrowing from a well-known opening line from a book, that it is a truth universally acknowledged that an insurer in possession of a good product must be in want of a partner. From the very early days of microinsurance, when this image of the Greek god Janus was used in the Microinsurance Compendium, edited by the ILO, by the way, to illustrate the dual nature of inclusive insurance as a new market for insurers and a tool for protection of vulnerable households, we know that inclusive insurance can only reach scale through partnerships and supportive ecosystems. And the landscape study consistently points in the same direction. Traditional distribution channels such as MFIs and banks remain important, while more untraditional or innovative channels such as value chain aggregators, sellers, and distributors of fast-moving consumer goods, as well as others, are playing an expanding role in extending access. And I think we will hear some examples today about those innovative partnerships. But we also know that programs delivered through organized groups that have a closer relationship with customers tend to demonstrate stronger claims performance and therefore offer more value to customers. The broader financial inclusion environment also strongly influences uptake, providing the rails for premium payments and quick payouts. And finally, public support is another critical enabling factor. In fact, if we look at the last bullet of the slide, we'll see that for agriculture insurance, 58% of products receive subsidies, and subsidized programs account for 97% of people covered in agriculture insurance. Finally, I would like to leave you with an invitation. If you move to the last slide, please, Lisa. What I presented here is part of a platform of database knowledge and insights that comprises the landscape of microinsurance report, which was mentioned here, but also now recently we have launched a data hub where you can interact and filter the data according to your needs, as well as a resource hub with different reports and a wealth of resources that's been collected and produced by MiN and its members throughout the years. And our hope is that this platform can support the resilience agenda by providing a people-centered measurement framework with more substantial performance indicators for inclusive insurance that go beyond the traditional proxy of premium income that I mentioned at the beginning. So I'll remain ready to answer your questions and engage in the debate. Thank you again, and looking forward to the discussions.
Fantastic. Thank you, Pedro. Just a reminder, if you have any questions, do put them in the Q&A. I don't see any at the moment. Just checking. So yeah, please do put them in the Q&A. So Pedro has done a really great job in answering this question of, how inclusive insurance can be this cog, this last mile delivery in this broader risk management context. So at this point, we're going to turn to two fantastic, really interesting, innovative examples of how this can be done. And I would like to introduce our next speaker. So let me just pop up his slides and where have your slides gone? There they are. Voila. Okay. So our next speaker, Jaime. So Jaime is the CEO of Blue Marble, and he has held a variety of positions in finance, consulting, and international development before joining Blue Marble when it was launched. Jaime holds an MPA in development practice from Columbia University and law and business administration licentiates from ICADE, and he is also a registered lawyer in Madrid, Spain. So Jaime, welcome, and thank you for joining us today. So again, as I did with Pedro, I'm going to ask you a couple of questions and then hand it over to you. So the first one, I'm sure many who have joined this webinar today have heard of Blue Marble, but just in case people haven't, if you could tell us a little bit about Blue Marble, who you are and what you do, in a short answer. And then secondly, if you can share some concrete examples of how Blue Marble designs inclusive insurance solutions to help vulnerable communities build resilience to climate shocks, and what innovative approaches you see emerging in this space. And then thirdly, if there are any lessons that you could share to date, that would be great. So Jaime, over to you.
All right. Thank you, Lisa. Okay, so well, first of all, thank you for having me here today. It's a pleasure to speak to you. I think if we can move to the first slide in the presentation, I'll kick off with this little ad about us, just answering that first question you you asked me, Lisa. So for those of you that don't know us, Blue Marble is an impact insurtech with a mission to bring insurance to the world's underserved communities. And we do this with a tool, which is parametric insurance, and this is to drive climate and financial resilience for these communities. And we're backed by a consortium of insurance organizations, which are formed by MAPFRE, Aspen, Zurich, Marsh, ASA, and Transre. If you can move to the next slide. Thanks. So just to continue in this brief intro, for your awareness, we work with a variety of private and public sector partners, and this is because we believe that the way to deliver on this mission and to accomplish it is by partnering and forming these public-private partnerships, because this enables to build that ecosystem, which makes it a reality. In the private sector side, we have food and beverage companies and financial institutions, and on the public sector side, a variety of international organizations, governments, and NGOs. You see there as well the footprint of our work. We are active in more than 20 countries, and also the media where we have been referenced, and we believe we're a brand well known in this space. And if you don't know us, well, there's a good opportunity for that. And then the last slide on the little ad about us is number 3, I think, yeah. And it's just about the type of services we provide, just for everyone's awareness. So the way I like to say this is consulting really is creating the building blocks that enable us to provide access to insurance. And this is because when you first go to a market, there might be a need for a feasibility study, do capacity building. There may be a need to do risk analytics in order to persuade an actor that it's relevant to de-risk and to transfer risk. So that requires some, let's call it building blocks that need to be created. Then comes modeling, which is the actual creation of these products, and in particular parametric products. We design through our in-house software and our modeling team products that are looking at both climate and natural risk. And lastly, protection, which comes in the form of the Impact Reinsurance Facility, which is a facility created for the dedicated purpose of providing reinsurance in the space of climate risk, intersecting or targeting underserved segments. And it is backed and written with Zurich Insurance's paper, who act as the lead reinsurer. All right. And then to your second question, Lisa. So you were saying, how is it that we actually implement inclusive insurance and add innovation, right? And so rather than give you sort of a theoretical framework, I thought it would be a good idea to walk you through an example where we're doing this. So in the Kyrgyz Republic or Kyrgyzstan, we have been active for the last 4 years. And there we have actually implemented an inclusive insurance product that is innovative in two ways. So one is that we've actually created a MISO level product that is being delivered through the social protection structures of the country. It is actually at district level, and it's with subnational governments that we're working, and is leveraging the infrastructure, if you will, social infrastructure already in place to deliver payouts. And the second feature that's innovative is forecast. And it's because we're using forecast data and we're actually underwriting and then paying out based on forecast data, which enables to pay earlier than the actual event unfolds, which adds a benefit, right? And I'll double click on that in a moment. With regards to progress to date, so we have impacted or reached more than 32,000 vulnerable pastoralist communities. The product is offered to vulnerable pastoralist communities and is protecting them primarily against drought, although also early onset of winters, and it's protecting the pastures of these of the livestock they own. To date, we've covered more than 4 million in capacity or risk capacity and made payouts of around, well, actually more than $300,000. And the product is present now in multiple regions across Kyrgyz Republic. This is the result, and I think this important feature of which has been mentioned before by Pedro and at the beginning by Lisa, of a public-private partnership, and it's this point around partnerships. So everything we're doing is possible because we are working with all these partners. So you have institutions here, such as the World Food Program, such as ILO, coming from, if you will, the UN system, which each of them provide fundamental input into the program. You also have funders such as the Insurance Resilience Solutions Fund and SCBF, which enable this to happen, as well as the ADB. You have then insurers that enable them to distribute this product and underwrite it locally with the appropriate licenses, and then the reinsurance that comes into place. It's really this ecosystem of players that makes this happen. And it's important to have all these players also working towards a vision of sustainability and long-term viability. And in order to ensure that, we need to then have a couple of pillars in place. So one of them is actually the work we're doing with ILO, which is actually building capacity locally by means of actually strengthening the local capacity of insurers. Because if you have actually insurers that understand these products well, that have the capabilities to actually underwrite these products locally, understanding the products, and then actually talk about these products, you're building from strength and you're scaling up from strength. Then we have obviously the work we're doing with the World Food Program as a key deliverer of the actual benefit to these pastoralist communities. And then the vision of linking this as a national insurance program such that this can be embedded into a national and government agenda that can have a long-term view. Okay. And then moving to the next slide, as I said before, I just wanted to double click on the forecast insurance product because this is, I think, one of the most innovative features about this program. So we're actually using forecast data for this. That means these are products created with observations that are looking to the future. It's not actuals. This means, therefore, that you can actually have payouts done before events unfold. This comes with its own complexity in design and underwriting, etc. But once that's in place, the beauty of it is that you actually can have a benefit be paid before the event unfolds, which actually reduces the shock. It helps mitigate that shock, right? And so in this case, what we're doing is working with our partners, distributing feedstock to these pastoralist communities. And the reason why this matters is because when livestock, when droughts hit and pastures are hit, livestock cannot feed off pastures. When that happens and it also hits crops, another effect happens, which is the price of fodder to feed livestock also goes up. So you have a double effect, which is if you're an owner of livestock, now you're not only being faced with the fact that they cannot feed just from pastures, that buying from the shelf a fodder is going to be extremely expensive. So that forces you into a vicious circle, which means a vicious cycle, which means you have to sell off, you have to decapitalize in order to be able to sustain. Send to abattoirs when everybody else is sending to abattoirs, which means you're going to end up getting less money for your animals and having to decapitalize your base. So instead of getting into that vicious cycle, if we can distribute fodder before all of that unfolds, we can prevent that from happening and help that community sustain that shock, build a resilience for that community to actually get through that season. And then when the next season comes and the rains return, they'll be able to feed off. So the idea is how to reduce that damage up front through this product. I also want to caution that this is one of the first times this is being done. Therefore, there's a lot to learn from this. And for us, this is a learning opportunity. We're improving this year on year. We're improving on data sets. We're improving on underwriting. We're improving on distribution. So we're very open to sort of like a community of practice that can help us also learn from this. And that's part of the reason for building a partnerships around it. But just want to stress that the only way we can actually build resilience and innovate as communities is being open to testing things and learning from it. And this is just an example of how we're doing it. And then maybe to the last slide. So on lessons learned, just want to emphasize that point on the importance of acting early. For us has been something we've learned. We've done a lot of focus groups to understand how is it that these effects unfold, and realizing that if you act early, again, you reduce significantly the damage of these events. So acting early is fundamental. It's fundamental to build, to strengthen the ecosystem, invest in capacity building at the local level, build ownership, have regulators feel comfortable with this, feel government actors at all levels, national, subnational, feel comfortable with this type of products, understanding them. Insurance industry, everybody really needs to understand, because it does take that entire set of stakeholders to drive this forward, and it can only be done if there's local ownership at the end of the day. Efficiency via automation, the importance of parametric models enabling fast liquidity, and lastly, public-private collaboration. I think I'm repeating myself quite a bit on this point, but I just want to stress it again. It's fundamental. Like the only way for this to be sustainable and be done over a long run is if we get everyone together. So those are, I mean, I'm sure there's many more, but just to highlight a few. And that's it. Thank you, everyone, for your patience, and I'll be looking forward to questions.
Great. Thank you so much, Jaime. That was really insightful. And I can see that the questions are coming in fast and furious, which is great. So keep them coming. But just so that we can stick to time, I'm going to introduce Lillian. And then after Lillian's presentation, we should have some really nice time for discussion. So Lillian, I'm just going to get your slides up. And yes, there we go. So let me introduce Lillian to you. So Lillian Waithaka is the Senior Programs and Innovations Manager at Acre Africa, bringing over a decade of experience in inclusive climate risk solutions. She specializes in agricultural insurance, digital finance, and the use of GIS and Earth observation to support smallholder farmers. Lillian is passionate about financial inclusion and advises governments, donors, and private sector partners on climate resilience, and champions scalable models that expand access to insurance and smart finance for underserved communities. So she is perfect for this webinar. So Lillian, I'm going to do the same with you. I'm going to ask you a couple of questions, and then I will hand it over to you. So again, just in case people have not heard of Acre Africa, it would be great if you could just tell us a little bit about what Acre Africa is and where you work and how you work. And then going back to something Pedro said, he talked about reaching the last mile with coverage. So how does Acre Africa reach hard to reach groups? So here we're talking about, for example, remote farmers or nomad pastoralists, and especially women. How do you educate them on parametric insurance? This is something quite difficult with groups that are not familiar with insurance. And then lastly, also, if you can share some of the lessons that you've learned. So Lillian, welcome, and over to you.
Thank you so much, Lisa, my distinguished speakers, and all the participants. So delighted to join the dialogue. So again, my name is Lilian Waithaka. I'm a climate data analyst, and I work with Acre Africa. Acre Africa in full is agriculture and climate risk enterprise. And I'd just like to draw everyone's attention to this particular slide. So I'm sure everyone has, maybe not everyone, but everyone in this webinar has probably seen this statement. So in rural Africa, climate risk is not theoretical. It determines whether a child goes to school, whether assets are sold, or whether a farmer plants again the next season. Yet, fewer than 3% of Africans have insurance coverage, and agriculture insurance penetration is still estimated at below 1%. So that means climate shocks are still absorbed at the household level. So ladies and gentlemen, this is the very reason why Acre Africa exists. So we are a for-profit social enterprise. We were founded in 2009 as a project dubbed Kilimo Salama. For those who know Swahili, this means safe agriculture. So it was one of the very first experiments in parametric, or basically agriculture insurance. We experimented using automatic weather stations, and from this we were able to get very important insights that really informed our transition into a for-profit enterprise. We basically currently have physical offices in Kenya, Tanzania, Zambia, Rwanda, Zimbabwe, and Nigeria. And as you can see in the map of Africa there, we have footprints in a number of countries in Africa. We are a subsidiary of ZEPRI, and ZEPRI is a COMESA institution, a reinsurance institution, and a major reinsurance company. Acre Africa's core mission is to strengthen the resilience of smallholder farmers by providing innovative risk management solutions, operating in a region where agriculture is both a livelihood and a risk-prone venture. So what we do is just address the specific vulnerabilities that make smallholder farmers economically insecure and underserved by formal financial systems. In terms of impact, Acre has reached over 3.5 million smallholder farmers since our inception. And in 2026 alone, we project that we'll be able to reach about 1.5 million farmers working in the countries that are highlighted in the map there. So the next slide, Lisa. So Acre basically provides holistic climate solutions to smallholder farmers, and we leveraged on these three key components, which include digital, so using digital tools to design our products. So we design both parametric and indemnity-based products. We're able to also deliver the products using digital platforms, and also in order to reach the last mile who we are working with, we also leverage on different interventions and innovations that I'm going to be speaking on in the next slide. Next slide. So I dare say that the biggest barrier to agriculture insurance is not really affordability. It actually just stems from awareness, trust, and distribution. So that's just a citation from World Bank 2022, which states that microinsurance uptake is constrained primarily by low awareness and distribution inefficiency. Many farmers conceptually may understand the concept of insurance, but lack product-specific knowledge. So if a product is misunderstood, it will be mistrusted. And if it's mistrusted, then it will never scale. So there's no, and that's where Acre Africa comes in terms of how we distribute our products. So currently, or how we approach it is that we don't have any single distribution model that works across Africa. So we are basically exploring different channels, and we have layered these channels into the following approaches. So we have the micro level, we have the meso level, and we also have the macro level. So for inclusion and for impact, that's where the micro level distribution channel or approach comes in. Then for the meso level, that's where sustainability comes in. And the macro level, that's where now we have the systemic changes and scaling coming in. So in the next slide, I will basically look at the three scenarios or the distribution channels, just speaking to how we approach them and how they're structured. So for the micro approach or the level of distribution here, the direct beneficiaries are usually the smallholder farmers, usually either having farming as a business or basically just for subsistence. Then we have who pays the premium here. Farmers mostly pay the premiums here, but also have potentially some subsidies. Then the product types here, as I mentioned, we have parametric and indemnity-based products. And mostly for the smallholder farmers, we usually target them with the weather-based products since they're more affordable. Then the type of risks insured here could be the drought and excessive rainfall. The value insured, basically looking at the production cost, could be the cost of seed, could be the cost of labor and mechanization in case the farmers are using such in their production. And to just basically give an example of a micro approach to distribution that we leveraged upon at ICA Africa, it's the Champion Farmer distribution. I'm sure most of you have heard of it. So basically, we leverage upon existing social structures in the communities. Champion Farmer basically is a key opinion shaper in the village that they exist in. So we basically look at also gender dynamics and inclusion in this model. 60% of champion farmers at ICA Africa are actually women, looking at encouraging and playing the role of a role model so that more women can uptake or experience the product. So the other channel is the meso level. So here is where we, as also James said, we try and look at how we can partner with other organizations such as microfinance institutions, input providers, and other community-based organizations, looking at basically, just a minute. Sorry. So looking at players in the agriculture value chain, the policyholders here in most cases are the agriculture value chain providers, the agri-service providers like the MFIs, the input providers. So basically looking at protecting the portfolio against any risks that occur. So they take this on behalf of their farmers. For example, for the input providers, they usually take up the insurance cover as a marketing tool. For the MFIs, they take the insurance cover to de-risk their portfolios against default by farmers as a result of climate risks. And finally, for the macro level, this is where we work with the governments or the county governments. They basically take insurance covers on behalf of the farmers in the different counties or basically to safeguard them against any climate risks that could be experienced. Some of the examples of the macro level of distribution is the National Agriculture Insurance Scheme, such as the Kenya Agriculture Insurance Scheme. We also work in Uganda and also Zambia. Next slide. So when it comes to awareness creation and education, I'm sure many people really always insist that parametric insurance fails when it's technically sound but socially misunderstood. So there's need for us to create more awareness and capacity building in line with what parametric insurance is all about. So this is basically the approach we take. We have before enrollment, during enrollment, and after enrollment. So before enrollment, we ensure that we make it understandable. So we use interventions such as edutainment, basically meaning education which is entertaining. So currently, for example, we've partnered with a local entertainment show called Shamba Shape Up. Basically, using gamification plays, role plays to ensure that the concepts of insurance are basically understood, making them very clear and very easy so that they're understood. During enrollment, using both digital enrollment tools, of course, this one's the low-touch models, they help us in scaling, but with the high-touch models, you have that physical interaction and it promotes trust. So both channels need to be used to encourage skill and also more transparency and trust. So after enrollment, also, we just continue building trust through keeping the communication alive, sending advisories, sending reminders on, the next season and that you need to take up insurance to cover your portfolio or your crops in the next season so that this trust is reinforced even in the next season. So finally, as some of the lessons learned when it comes to basically reaching the hard to reach, is that distribution is one of the hardest problem. So reaching last mile cost effectively is a constraint. So we need to look at other alternative approaches or just pivot so that we're able to build more inclusive approaches, like I already mentioned, the micro, the meso, and the macro. Then low awareness levels in especially Africa, as I mentioned in my very first slide, is real, and we need to also bolster our interventions towards creating awareness so that uptake can also be improved or increased. So education is also not optional. And lastly, in as much as we're in a digital world, we need to also ensure that we still maintain the physical interaction, especially when we're dealing with the rural communities and women who thrive in social setups. We need to use both of them to complement and ensure that we drive uptake of inclusive insurance and especially agriculture insurance solutions. So that's it from me. Thank you.
Great. Thank you so much, Lillian. And I really like the positive take on, it's fixable, some of these problems that we experience. So I don't know if you want to say anything about this this QR code.
Yes, so this QR code basically just wanted people to have a taste of how we do our edutainment, partnering with the local organization, TV stations, to pass the message around inclusive insurance and agriculture insurance and parametric insurance and why it's needed and how we can go about also debunking very harmful gender norms and cultural norms that exist in the African setup. So please feel free to scan and in your free time, just listen to that YouTube video. Thank you.
Brilliant. Thank you so much. Great. So with that, we actually still have really good time. I'm going to stop sharing the slides. We have good time now for discussion. So I'm going to turn to the chat and the Q&A, and we can start looking at your many questions. I see some of them have been answered in the chat, but to get the discussion going, I'm going to skip over Alex's question about the definition of inclusive insurance because I saw that one had been answered. But I'm going to start with Henry's question. So this one I don't think has been answered, and I think it's for you, Pedro. So how do we move inclusive climate insurance from pilot programs to commercially sustainable, scalable national frameworks, since many schemes remain donor-driven? Actually, you could probably all answer this, but maybe, Pedro, do you want to have a go?
I can have a go, although I feel like the presentations might have hinted at one potential answer for that. And I think for a long time, I think the theory was that we could potentially rely on resources that were committed under the climate conference framework for adaptation to be channeled via the various sort of financing multilateral bodies or bilateral cooperation agreements. And that, I think, has gained a lot of traction, but perhaps we're seeing a moment in which that's under a lot of pressure, and the model of piloting and not being able to scale up is also there's a bit of a fatigue around that model, I believe. And what we're seeing with organizations such as the ones that are here today and many others is that we are increasingly looking to understand where in the value chain there's a vested commercial interest in the outputs of the downstream kind of elements of the value chain, so that the cost of insurance can be spread throughout the value chain.
Mm-hmm.
And I think the examples we saw here today are great examples of that. And I know that Acre Africa and Blue Marble have even other examples of how that works and what kinds of interests that play out in this equation. I think in the agricultural insurance arena, that has been more well tested, and I'm yet to see how that could be adjusted to, small business in urban areas that are affected by flood, for example, and so on. And ultimately, as I mentioned, I think there's also sovereign kind of interest that ultimately will have to sort of bear the brunt of the climate impacts, and that's where governments will have to make a strategic decision in relation to what types of insurance they'll pay the premium for, as the exposures also evolve. But I'd love to hear from Jaime and Lilian as well, if that's possible.
Absolutely. So let's turn to both Jaime and Lillian with the same question. So this is a very good question, because we do see lots of pilots with lots of potential, but how do we take it from being a pilot to something that's commercially sustainable, scalable? Is that really the goal? I guess that's another question. Or do we stay thinking about sharing the costs? So yeah, let's which of you would like to go first out of Jaime and Lillian?
I'm happy to kick
go
in.
for it.
Yeah, it's an excellent question. And I would say the pathway, to commercial sustainability, let's say I think it's different by context. I think that's the first realization, right? It's not the same to be talking about a low income setting that a middle income setting. It's not the same talking about groups that are ultra poor than individuals that are just above the poverty line. I think it's important to segment and to have a strategy that's adapted and is realistic with the context in each piece. So from that, what we're observing in middle income settings, strategies which bundle insurance with other services, in particular other financial services such as credit, scale up very well. We're seeing a lot of evidence of that and having the potential to continue doing so. I think that that's a well-tested and sort of progressively scaling channel. We see also hybrids that leverage existing distribution channels, whether it is cooperatives, federations, even existing, agent networks to scale up is a great way, and we also have evidence of that. But then it's also the realization, especially in low-income settings, and it's that, and I think in agriculture in particular, we already see in developed countries that this industry is subsidized. There's agriculture subsidies. There's different reasons for that. It might be food security, even national security, for rural development. Many reasons why you may justify actually de-risking the agriculture sector in a country from a national sort of agenda, and why that may justify actually putting a budget and dedicating a fiscal budget to that end. And we see that countries that can and do and are able to afford this and set it up as a priority, that is a good way as well to scale, in particular in agriculture. It doesn't mean that it has to absorb the 100% of the premium, but it can certainly help support reduce that. And that's because of the realization in many of these contexts that the risks are very high. And when you actually price all the risk in, it can become unaffordable in some settings. And there's a need to also have this real discussion. So I just wanted to add to what Pedro was saying, but adding that sort of lens of adaptation to the context and being realistic about what that sustainable long-term view is, depending on the context and the segment.
Brilliant. Thanks, Jaime. That's a great nuanced answer. And yeah, it depends on many things in the context. So Lillian, is there anything else that you would like to add to this question or yeah?
Actually, I also just double down on what Jaime has said. Most of instances where we have experienced scale and sustainability is when we are working with aggregators, so the meso level or the macro level of distribution channel. So currently, also we are working with a number of microfinancial institutions, and majorly our business also comes from basically that side of business. So just to echo the sentiments that have already been said.
Great. Thanks so much, Lillian. Right. So we have lots of questions. Let's carry on. So the next one is actually for you, Jaime. So Alex wants to know, what do you mean by delivered through social protection structures? Which structures?
Yep, sure. So, but what I mean by that is the social safety net program that is actually delivered by district administrations within Kyrgyzstan. So actually, there's a social passport. Vulnerable families have this or are identified under this program, and it is these vulnerable families that are being targeted, and it's through this social safety net program that we are embedding the payouts. So that's concretely what I mean by that.
Okay, fantastic. And then just moving down the list of questions, we have another question from Nga from the military insurance in Vietnam. He says, please could you share your experience with implementing parametric-based property protection products for low-income households in countries like Vietnam, particularly those that provide lump sum payouts in the event of typhoon and flood? So I don't know if you've done anything like this, and here I'm assuming property means property rather than livestock, which is also property, but yeah, actual buildings. So Jaime and Lillian, have you done anything on the property front or with lump sums related to typhoon and flood?
We have worked with cyclone or typhoon type risk. The assets covered, I mean, we have worked with property risk and also business interruption type products, I would say. So we have experience doing these. In Vietnam, no, if that was the question, but in other countries, yes. And indeed, the way they typically work is in the event that these events take place, right, and the triggers are met, because we are talking about parametric insurance, there is a lump sum payment that is made. And perhaps just to add there, the nuance is that parametric, which by the way can be added to indemnity products, right, as a rider, what it adds is that extra liquidity or that just payment just in time, which can be quite beneficial and complementary to indemnity covers. So that just to add a little bit of extra detail to that. Yeah.
Okay, fantastic. So I'm going to jump around and take the questions a little bit out of order just so that we spread them out between our speakers, just in case we start running out of time. So Lillian, I'm going to come to you now. So we have an anonymous person asking, how do you cover the costs of pre and post enrollment activities? Are the costs loaded within the premium rate?
Right. So I'm going to answer that in two ways. So when you're starting in a new market, normally that cost is covered out of, let's say, a grant or an alternative source of revenue. But as we continue with our interventions in the market, then once we have experience, we normally leverage on our digital platforms. So you find that the cost of awareness creation and capacity building is kind of averted by using of the digital platforms. And I know there's the issue of penetration of, let's say, like mobile phones, because that's what we leverage upon to implement our awareness creation and capacity building initiatives. But as it is, when we are groundbreaking, we do have that cost, we incur the cost. But as we go, we also factor that in the cost of premium and also leverage on digital platforms.
Great, thank you. All right, so next question is for Pedro. So Pedro Maxi has asked a question. He says, in your opinion, Pedro, why do so many insurance companies and even regulators still not fully trust climate insurance as a key aspect of their business? And what role do multilateral organizations play in helping to promote this agenda?
Well, loaded question.
Good luck.
Yes. Well, I would say, maybe there's an introspection that is required from the insurance industry itself about how it markets its products and engages beyond the insurance sector. I think we can all agree that we tend to speak to ourselves in many of the events we go to and the rooms we normally attend. So I come from a country where the insurance industry works very closely with banks, and bank assurance sort of dominates a large share of the insurance market. And more recently, the financial sector as a whole, but the banking sector more specifically, has undergone a huge transformation with new market entrants. And I always ask myself how much the insurance players that are already linked to banks or independent are actually reaching out to those fintechs that are emerging to sort of spread the word about insurance and explain the value of insurance to the financial services clients of those organizations that are emerging. And here we're only talking about the financial sector. So if you start thinking about the other many sectors of the economy that where you could also be sort of talking about climate vulnerability, exposure, and the role of insurance, then you don't need to be selling it necessarily individually to customers, and that goes to the point we're making here about the importance of partnerships and aggregating customers, right? So I think that's my attempt of an answer to that. I think there's when we talk about insurance awareness, it's not only about whether the customer, the end customers understand insurance, but whether there's a systemic understanding of the role of insurance in society that then allows it to be part of the resilience infrastructure that we were talking about earlier today.
Mm-hmm. Thanks, Pedro. I think from the role of multinationals, it's also about promoting responsible insurance, following best practice, making sure that people are not let down by bad products. So I think there's definitely a role. All right, so back to Jaime. So Alex has another question for you. Is coverage triggered by actual rainfall observation early in the season as a precursor to the ensuing drought, or is the trigger an actual black box forecast model itself? So I assume this is with the Kyrgyzstan forecasting model, forecasting project.
Yeah, it's a great question. So the forecast model is actually built on data, open source data that we source from a satellite provider that is using historical forecast models, right? So that enabled us to price the history because it is quantitative data, it's not qualitative data, and then that enables us to then use that data to price the risk. And then the way we monitor it, right? I think that speaks to your point. It is based on forecasts, but we do actually retail this with also a component of a hybrid that looks at observed data as well. So we do try to embed as much as possible the best of both worlds in a way. So the actuals and the forecast and the way we design the products. But just on the forecast in particular, we do use open source data. It's not sort of a forecast model that we've created or something like that. It is open source data.
Great. And actually, while I've got you, let's ask a question from Chalpan. Hi, Chalpan. Great, you're online. So she says, thank you for hosting me in Kyrgyzstan, of course. In your experience in other countries, what are the critical conditions that must be in place for local insurers to move from pilot participation to real ownership of such solutions?
It's an excellent question. I think you need one at the top of the organization, you need to have alignment. I think this needs to be a strategic priority. It needs to be within the strategic plan. There needs to be alignment with where the organization wants to grow into, such that this becomes a core pillar of that. And then that then needs to be materialized with a concrete plan that leads to actually hiring or setting up aside a team or a person at the very least that is dedicated full time to this end. And then it's equipped with the resources to make this vision a reality. And that needs to get coupled with, again, and I'm talking about best practice of what we've experienced and has worked, right? There might be other options that have worked for others, but for us, this have been essential pieces to it. And then the openness to participate and with actors like ourselves and we were mentioning institutions that we work with to this end to actually receive, be open to participate, to receive knowledge, to engage with it, to actually take it upon and grow it. And then the last piece is be proactive. Right. So it's one thing to be reactive and receive all of this, but then if you need to transition to ownership, you need them to be proactive, to lead this themselves. This cannot be something where you're pushing knowledge. You really need that local, and I say local, but just really that ownership from the institution. And I think these factors are preconditions for that, but don't guarantee that that will happen, right? And so I think those are the key features we see that when they're in place, we tend to see this being driven that translates into ownership. Something just to throw an example, branding products helps because it helps them not just see this as a strategy to have extra revenue, if you will, or profit, but actually as a way to differentiate in the market. So then they can gain market share. And so there's ways in which you can actually build up a strategy to differentiate yourself, which then becomes more strategic to the company and the leadership to push this initiative. So I think these are features we think, help.
Yeah, those are great points. Thank you, Jaime. So Lillian, let's come back to you. So we have a question here from Tarek. Tarek, it's great to see you or read you on this webinar. So he says, hi, Lillian, nice presentation. My question is which one you see most successful from the micro, meso, and macro level? In terms of claim ratios, which one is the highest?
All right. Thank you for that question. And I'll be honest and say that we've basically not really looked at each individual channel and looked at the claim ratio because we normally use all the channels to generate whatever revenue or to calculate the claims ratio. But what I'll say is that success looks different for each layer and at each layer. So at the micro level, as I said, success is all about inclusion and protection and impact, right? So claims ratio here can sometimes be very high because products they cover more frequent and localized events. When you look at the meso level, which if you're looking at like microfinancial institutions, where we have a portfolio of farmers, then the risk here is diversified and spread across many farmers and geographies, so it's less volatile. Then when you look at the macro level, here the claims ratio could appear low, but we basically look at it over a number of years and not season to season, because it's usually designed, or the products are usually designed to trigger during very extreme disaster years. So I don't have an answer for that, but I think, or I believe that success looks different for all the channels.
Great, thank you. All right, we have lots of questions, so let's keep going. Thank you so much. So this, I think, is maybe a comment or a question, I don't know, but Pedro, this one I think is aimed at you. So Henry says on the protection gap that was mentioned by the first speaker, in African markets, climate risk is not just an insurance issue, but a development issue itself. If we do not solve the affordability equation, inclusive insurance risks becoming conceptually attractive, but economically inaccessible. So Pedro, do you have any thoughts on that comment?
I think it relates to the answer we gave first about, the premium co-financing, the subsidies, and sort of spreading the cost of insurance so that the affordability issue can be addressed. But I absolutely agree that this is, in many ways, for developing countries, a political issue, right? And this comes up in political discussions around and climate negotiations. So I do understand that there's an underlying issue of inequality, income inequality globally that needs to be addressed before we can effectively target those issues. I guess and I don't have the solution to that, unfortunately. Yes.
All right, thanks for commenting on that. All right, Jaime, we have lots of questions for you. So from Michael, Michael says, how is the correlation of forecast model to the on-ground experience? How do you manage basis risk in the case of false alarms? That's a good question.
It's a great question. I would distinguish between two types of forecast models. So you have the short-term forecast model, and I think forecast data right now, the state of the art of the industry is about a week, maybe 7, 5, 9 days, right? At which point the correlation is quite high. After that, it starts to drop, right? So there's pretty good forecast models out there for that type of range. For those, and again, and I think there was another question there about whether it's slow onsetting or fast onsetting risks. I think that's a really good distinction as well, because if you're looking at a week in advance for a hurricane, that could be relevant, right? Because having a payout and being able to take preventive measures in advance could be relevant, or a flood. In the case of more of a monthly or a few month data, there we're getting into the space of anticipatory actions. And there, actually, the correlation is not so much with the actual loss, which, to be honest, that could be quite a bit of a difference there. It's actually with the use of those contingency funds set aside for anticipatory actions, meaning if you have actually a formula that establishes when certain forecast with a given few months is triggered, then you're going to release those funds to actually enact or to put in place anticipatory actions. Then actually you're measuring against that use of funds. That's what you're correlating against. And actually the correlation can be up to 1 if you're actually using the same exact formula. So once you kind of make that mental shift between the actual ground experience and what you're actually measuring relative to, in this case, the use of those contingency funds, you start to realize that this instrument can be quite powerful and manage quite well that basis risk, because it's less about when the loss happens as much as when that anticipatory action is triggered. Because the underlying knowledge, the underlying understanding is that you're better off spending on anticipatory actions, even if sometimes you get it wrong, because the time you get it right, you actually save so much. And I think there's studies out there that are looking at 1 to 10, 1 to 15 in terms of like the potential savings you're doing. So you have many chances of getting it wrong and still this being a worthwhile use of funds. So I think that's what you're comparing against. And then in terms of the relative spending and the opportunity costs of this initiative versus not having an ex ante strategy that sets aside funds and adds that multiplier of insurance, that's where the calculus comes in, right? So I'm just putting it relative to what you want to compare when you're putting in place these forecast models.
Great, thanks, Jaime. And I think that's a very similar question to the one asked by Asma Jabri. So I'm not going to ask that one twice. But I have another question, Jaime, quite a few for you. But this one from Shelley. And she says, Jaime, the Kirk's example is really interesting and inspiring. I love the innovation, but also the recognition that commercial requirements can make testing and learning on smaller pilots a challenge. How do you navigate this with your insurance company backers?
Excellent question again, because anytime you innovate and especially with underwriting teams, we're talking about a particularly conservative cohort for good reasons, right? So every time you're trying to push an innovation, it's a hard negotiation, I would say. Piloting helps in that the amount of exposure, right, is smaller. So you can start to pilot these innovative concepts in a way that perhaps the exposures are not that large. So it helps underwriters feel a little bit more comfortable, like moving a little bit that requirement. And it's that way that we can get all those concepts going. But the risk with doing too many pilots, right, and not having a view of what the scale is that you stay there. So that the second piece of that is that linking it to a clear pathway to scale and how that can become a business, right? So that you're not just experimenting for the sake of experimenting, you're experimenting because if you get it right, there's a potential big commercial opportunity to do it, and that's why it's worthwhile doing it. So I'd say that's how we go about it. But yeah, this is a tough one. I admit.
Great. So we just have 3 more minutes, and I think maybe time for just one more question. And yeah, there's lots going on in the chat, but yeah, they're not all questions. Okay, so we might have a few that are left unanswered, but let's go for this one. So Razal Karim has asked, are the livestock farmers in Kyrgyzstan willing to pay a premium? If yes, how much is the average premium rate? I think that is still yet to be understood, but I don't know, Jaime,
Yeah.
maybe you have some answers there.
Again, another good question. I think here is where I would say as I was answering before, the segmentation of the families or households that have been targeted are the most vulnerable, and therefore their actual level of affordability is very low. So probably the pathway towards that segment is not necessarily assuming there's going to be an exit plan at some point of full commercial viability. I think that's an unrealistic assumption for this cohort and this segment.
Yeah.
This is more about finding the right fiscal budget where this can be sustained. And I know that may not be appeasing to many in the call, but it's just I think there needs to be a realistic view of how do you actually manage that. That's different from another segment in that same country, which does have the ability to afford insurance, and that the pathway is actually through bundles with commercial, in this case, financial institutions and banks, with which we are actually in discussions to make this happen. That's kind of a later stage where we're targeting that segment, but just to give you a sense of how we're segmenting and having a proportional strategy or an exit path to each cohort.
Great, fantastic. So I'm going to ask one last question to all of you, and if you can just put it into one sentence. If there's one thing that you want people to take away from this webinar, what is that one message you would want them to think about? So sorry, Pedro, putting you on the spot. What is the one thing that you think you want people to take away from today?
I think it's considering inclusive insurance as the last mile aspect of a multi-layered approach to climate resilience.
Excellent. Jaime, what about you?
For me, is that in order to get inclusive insurance to its full extent, that we need to be working together, forming these partnerships. It's a prerequisite to make it happen, and that we have to adapt the solution to each segment, that we can't just have one solution for all.
Excellent. And Lillian, what about you?
Yes, my takeaway was we don't have one size fits all, so we really need to pivot and to adapt according to the different levels of society, affordability, even on the product side. So yeah, basically adapt and be flexible when it comes to these solutions.
Excellent. Well, thank you so much to all of you. I think it's been a really excellent webinar today. We're at the end of our time. So thank you to everybody who's stayed all the way through, and we hope that you've really enjoyed this. As I mentioned, we have all the recordings in English, French, and Spanish on our website. So do please watch this again if you want, or share it with others, and enjoy the rest of your afternoon or evening or morning, wherever you are. Thank you, everyone, and goodbye.
Thank you.
Thank you. Goodbye.
Bye.
Everyone. Bye.